Welcome back to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq, and we are live at Inside ETFs in Hollywood, Florida. Joining me for this segment is Bill Housey. He's a senior portfolio manager over at First Trust. We're talking about the hot topic of active versus passive investing with fixed income. Bill, I think you would agree fixed income has been one of the hottest topics at Inside ETFs for sure.
Absolutely. I mean, with interest rates moving, it's certainly important on investors' minds today.
Right. And so, but what are the challenges with typical beta fixed income products, especially as it pertains to credit investments on the high yield end?
Sure. Well, especially when you look at credit investments in particular, there's no doubt that active management is very important. And part of the challenges with the beta products is they're replicating indices that aren't really intended to be replicated for investment purposes. So when you look at an index, whether it's in the high yield market or the senior loan market, for example, those indices are simply constructed to represent the companies that have issued the most debt. So when you think about weighting towards, say, an equity index, what are you typically looking for? You're looking for something to tell you that there's a merit-based approach to owning those companies. So in the case of equities, maybe you're buying the biggest market cap, Apple, GE, Johnson & Johnson. In the case of fixed income, high yield, senior loans, those types of areas, the beta products simply represent which companies have had the most access to capital markets. So which companies have pumped out the most debt into a hot market. And so the more debt they issue, the greater your exposure to those companies. And we think that's fundamentally flawed as far as the approach that's necessary to lend money to companies.
Right. And let's talk about that credit risk and how do you manage that credit risk over at First Trust?
Sure. So, for us, it's really about a deeply disciplined and rigorous and repeatable process. So every company we look at, we're analyzing the financial statements, meeting the management teams. We meet 100 to 150 management teams a year, scrubbing the financial statements to better understand the risks in the business. If you just step back and think about the idea of making a loan to a company, it's really no different than if you were to lend money to a friend. You'd say, hey, when are you going to pay me back? Well, the same type of analysis takes place when it comes to buying the bonds or debt of a company. We're simply looking at these businesses to say, how likely are they to be able to repay that debt? How strong are the cash flows? How strong are the asset values or enterprise value to be able to support that debt? It's very important.
All right. And so why are high yield and senior loan strategies, are they appropriate in the current environment that we're in right now?
Yeah, absolutely. So when we look at correlations of these asset classes with traditional fixed income, what we tend to find is that they're very low. They have a very low correlation, or even in the case of senior loans, a negative correlation with, say, the Barclays Agg. So that means that when rates are moving higher, similar to the environment we're in right now, the Barclays Agg is coming under pressure. All that rate-sensitive traditional fixed income is selling off. However, senior loans have a floating rate of interest, so they tend to benefit in this type of an environment, while high-yield bonds have some spread that can act as a shock absorber. So when we see rates move higher, these asset classes tend to be more correlated with equities, which are absolutely doing well in this environment, and less correlated with the areas of the market that are tending to underperform. So when we think of solutions in this environment, senior loans and high-yield bonds tend to be very good solutions.
Right. You can see why active management is important on the fixed income end because there's a lot that goes into it.
Absolutely. Very critical.
All right. Thank you very much for joining us. And thank you, traders. Be sure to stay tuned throughout the day. I'm Jill Malandrino, Global Market.